Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, hello and welcome back to another episode of the ASB Investment Podcast. We're only a few weeks into the year and already the markets have been anything but quiet. They're well over their holiday break. There's been no shortage of big moves, big opinions, big predictions, which is exactly why today we're not doing another 2026 outlook kind of style show. We're going to focus on what January alone is throwing at us, what actually matters, and what investors should be paying attention to from here. I'm really pleased to be joined today by Frank Jasper, Chief Investment Officer here at ASB. Frank, it's great to have you back after a bit of a time away. What have you been up to?
A little bit of R&R, a little bit of sliding down ski slopes in Canada and generally getting away from the sun. So, I don't know, maybe the Grinch that stole Christmas, but loving a bit of time in the
So you chase winter, when some people chase...
Yeah, I do seem to these days, actually. I'm happy with a few little weeks of summer. That's enough for me. The rest of it, I'd rather be sliding down the hill.
Mind you, it's always nice down where you live, I think. But I guess if you could have sweet, fresh powder, every day you'd be happy.
It's an antidote to life.
Okay, right. So just a reminder, Frank leads ASB's investment arm, so there's no one better to help us cut through the noise. It's actually the first time me and Frank have hung out this year because he's obviously been a bit of away, so we've been catching up. We'll be talking through commodities, asset classes, election year risks, AI, of course, Bitcoin, the NZ market, winners and losers, and we might finish a little bit with what's on our minds in terms of advice for investors as well. Speaking of winners and losers, though, before we get into it, shout out to the whole team, us at ASB, as we've been nominated again for the Fund Manager of the Year for the KiwiSaver category in the Morningstar 2026 awards. And with that as well, overall Fund Manager, we're nominated for that as well this year. So you can sit back and rest assured that this conversation is brought to you by two award nominees.
Dear me.
There you go. Welcome back, Frank.
There's a start of it.
Welcome back, Frank. You've come back at the right time. So, Frank, let's kick off with January. It's barely over. Obviously, you've been doing a bit of R&R, but I know you keep an eye on things as much as I do. It feels like we've already had a whole year's worth of action, almost volatility, big moves, hot takes coming from everywhere. What's your biggest takeaway from just this month?
Yeah, it seems that we just keep having this, hey, this is unprecedented times, this is so unusual, there's so much going on. And the big takeaway for January is that despite the fact that markets actually by the end of the month were relatively stable, a small uptick in the S&P 500, so much is going on below the surface. We've got massive geopolitical changes going on. We've got unbelievable expenditure in AI that we'll talk about later on in the podcast. We've got earnings results coming out from US companies. We've got winners and losers from the AI revolution, the SaaS stocks, software, which again we'll talk about. So there's so much going on below the surface, but yet strangely enough, if you just look back at the history books and say, well, what happened in January? Well, the US market was up a little bit.
Yeah.
So it seems very unusual with this much action. Yeah. To have this little movement at the headline level.
Do you think, one thing I've noticed is the debate on where the market is and bullish, are we bearish, seems pretty evenly poised. I thought that's kind of good. Like it's always, when everyone's on one side of the boat, that's when you need to worry.
Yeah, there's really, really good research on this. So there's a guy that I follow, Michael Malbison. He's been
Morgan Stanley.
Yeah, Morgan Stanley these days with Credit Suisse. He's been around the shop, but he talks about the idea of diversity of opinion being really important underpinning of efficient markets. When you get lack of diversity in opinion, everyone rushes to one side of the boat. Turns out the boat tips over. So I think we're always looking for that diversity of view because that gives us confidence that there is actually a more balanced pricing going on in the market. When everyone's at the same side of a trade, watch out. And
take the other.
I think there's some examples of that which we'll again probably talk about.
And I guess talking about all that noise to start the year, do you think there's any real signals here, or is it early year noise? I guess is there anything that's standing out like? So goes what we've seen may go the year, or is it all just noise?
Yeah, so I think a couple of things. For me, there's a real connective tissue to the stories that we're seeing hitting us on an almost daily basis. And I go back to those building blocks of our thinking, which are the mega forces idea that the guys from BlackRock talk about. You can look at the news that we're seeing through that lens, and I think that really helps clarify what's going on. So if you think about the idea of geopolitical fragmentation, what's going on in Venezuela, what's going on in Iran, some of the discussions between China and the US, those things really do tie in and are real proof points to that thesis that we are seeing this move to a multipolar world, and that has some really profound implications for how we manage money. AI clearly is a massive driver of pricing. What's changed, I think, very recently is people are starting to realize that, hey, this is not just about the obvious primary beneficiaries of AI, but there will be winners and there will be losers from this trend. And the kind of dial has turned to thinking a bit more about, hey, who are the losers from this? And we've seen some dramatic price movements there. So I think there is whilst it feels very chaotic, there is this connective tissue that ties these price movements together.
One thing I've noticed over the last couple of weeks has been, to that last point around, we've seen, and we'll get to it, there's been some real sell-offs in certain assets or areas of the market where people think the sky is falling. But I saw a few NZ media outlets kind of put articles into, online that were kind of like, what's happened to your KiwiSaver balance? So-and-so, things plummet. I thought it was a bit premature. Have you noticed anything since you've been away, or are we just kind of jumping too early?
Yeah, I guess there is that general comment, isn't there, that if it bleeds, it leads. And so if you've got parts of the market that are bleeding, they're always interesting things to talk about. But that is why at the core of it, we build diversified portfolios. We don't just have all of our eggs in one specific part of the share market. We have it around the world. We have it in different types of companies. We have it in different types of assets, because I think this month has been a great proving ground for this, that things change and they can change very rapidly. And the best protection, in the absence of that perfect crystal ball that helps us determine exactly what's going to happen, the best protection is sensible, smart diversification, along with, I think, a good value discipline, and we can talk about what that means, but a good value discipline so that you just pivot your portfolio at the margin to reflect the world that you currently live in.
Well, I guess, as Jim Cramer said, there's always a bull market somewhere, right? And that's, I know it's cliche.
It's the truth.
But like if you're holding lots of different assets, something will be benefiting while something else cools off.
Absolutely. And that is a feature, not a bug, of how we build portfolios. That is by design. So if you see everything in your portfolio doing really well, it's probably a bit of a sign that there's something going on that could create problems down the track.
Yeah.
Similarly, if everything's doing poorly, that's usually a sign of opportunity. So very hard to train yourself into thinking like that, but that is the right way to think about these things.
And in your, because I think I've come to know that, so goes January, so goes the year, but that's probably more associated with some indexes that are the headline ones maybe. Do you believe that, or do you think... because January's been okay. Balances have kind of grown, and people have got. I don't think it matches some of those media articles. But do you subscribe to that theory or not?
No, not really. These are just sort of. It turns out the calendar year is just a bit of a human construct. But I mean, the numbers are that something they call it the January barometer. Something like 85% of months where you get a good start to the year, the market's in green, that will lead to
green
positive return for the year, and it's about a 17% return. That is just statistically what you would expect given the nature of average returns and the variability of returns. So there's no magic in that. There's no barometer. There's no science to that. It's just, on average, the market does perform pretty well. In fact, the weird thing is that, let's say the average return is about 10% for the market. Most years are actually much better than that.
Or sometimes worse.
But sometimes a lot worse. And so these are statistical anomalies that play out. But it makes everyone feel very smart to say these things. But that's not something that I guess I remember, a lot of time thinking about.
I remember in 22, I guess I look at equity markets a lot. There are other markets, I admit that. But, I remember in 22, I think January was poor and so was the year. Yeah. I always remember that's the most recent example. But I guess to your point, it's not something to maybe nail your flag to the mast on. No,
and I'll always try and go the next layer down. So if January is a good January or a poor January, what are the macro drivers of that? What's going on in the economy? What's going on with companies? Where are valuations? So if January's poor and you've started off with very expensive companies, that presumably speaks to more risk for the rest of the year. Yeah. Similarly, if you start with very inexpensive companies, a macro upswing, earnings increasing, probably not a massive surprise that you get decent returns for the rest of the year.
It sounds like as a great investor, you need to ask the whole 6 whys or whatever. Not just okay, this year's a write-off or this year's going to be great, as opposed to, well, why?
I think there's so much detail below the surface that are really important to understand. And, I think right back to the very start of this conversation that we had this sort of on the surface quite benign January, but so much actually going on that speaks to trends in the market that if you miss those details, you're missing a lot of
Well,
of the colour.
All right, let's tackle one of the main themes. It's probably been the one that's been in vogue for January, commodities, and specifically, I guess, gold and silver. I guess any thoughts on that, and whether or not you want to look at terms of, is this as I've seen some people call it, a commodities super cycle?
Yep. So one of the things I think that's really important to remember with commodities is it's not just a demand story. We'll talk about why demand's growing at the moment, but it is a supply story as well. And it's the combination of those two things that ultimately set prices. And in the very long term, supply always comes in if prices remain high. So I think bear that in the back of your mind whenever you think about commodities. It's something that is a foundational principle that a lot of people forget. What's really interesting with commodities right now, though, is I think they sit at the epicenter of a bunch of the megatrends that we've talked about. They clearly sit at the center of the AI megatrends. So if you think about the big AI data centers that are being built, if we think about copper as an example, it's one of the key commodities that get used in a data center. Something like 27 to 47 tons, a pretty wide range of copper used for an AI data center.
Tons.
So tons and tons of copper.
And it's hard to get anyway, isn't it?
Absolutely, and massive amounts of aluminium as well. So you've got this massive build out in AI that's driving commodities. You've got the transition to a green economy, the move to electrification. That supports industrial commodities, copper being a perfect example once again there. You've got the geopolitical fragmentation and the onshoring of supply chains. All of that speaks to really increased demand for commodities. So you've got these three big trends that are kind of adding together. At the same time, in the supply side of things, you've got a bunch of larger mines around the world, and I'm talking specifically about copper here, that have had force majeure events. So things go wrong at that particular mine that have constrained supply. So you add massive increases in demand that were quite unexpected in the case of AI in particular, with these force majeure events, and that's when you get increasing prices. Now, I thought those trends will last for some time, and it does take a while for the supply side to respond. But there's a great quote in Commodity World that's always a good one to have in the back of your mind.
World.
In the Commodity World, yep.
Oh, I thought I assumed it was like a magazine or a periodical. I was like, wow.
Yeah. I know. I need to read more widely.
It's a great dentist waiting room.
Yeah. What's the quote? That's the cure for high prices is high prices.
Right. Yeah.
I.e., at some point, capitalism does what it's supposed to do. That we see the copper price being high. There's not a shortage of copper in the world, but it does take time to build new mines, to bring production on stream, to grow that supply, and ultimately there will be a supply side response to this increased demand. So don't expect these trends to last forever and ever.
Yeah.
But they can last for quite some time. So there's some really interesting dynamics.
And
there.
I guess just quickly, one of the ones within the month that was probably, I think, got away from itself was silver.
Yeah.
I think at one point it was up 60% in the month.
Yeah.
And then obviously it's come back since then. Is that I guess there must be a demand thing there for legitimate reasons, but I thought it started to get pure speculation.
Yeah, totally. And I think that sat on the back of the move we've seen in gold, and silver. Silver oftentimes does trail movements we've seen in gold. But we saw a similar dynamic in gold where, and again, this is where the human being dynamics are really interesting. And we at the very top of this conversation, we talked about everyone running to one side of the boat. Gold historically has been a really good hedge for political risk and for kind of risk around the world. There's good reasons why people might want to include gold in portfolios. We've got an allocation to gold in our portfolios at ASB. That was a pretty non-consensus view 3 years ago.
Yes.
Sitting there in December 2025, that was anything but a non-consensus view. There were lines forming outside gold exchanges in Sydney.
That's right.
Your apocryphal Uber driver talking to you about the gold market. There was a real consensus opinion, massive run-up in prices, and that creates an environment where sell-offs can happen. Now, we're longer term of the view that these geopolitical fragmentation forces, the higher inflation that we expect to be somewhat persistent, those things are supportive of gold on a secular basis, but that doesn't stop a cycle from happening.
Well, let's zoom out. I guess, we talked about silver and gold, but, I was wondering and having a look at what have been the best performing asset classes so far this year. And I guess, so I'm interested in your take on them, Frank. I was having a look this morning and I saw, from my 6 screens in my home trading desk that I could see, I saw South Korea, these are year to date, up 29% in equity market. Again, we're talking the LATAM markets, Latin America, Peru, that major country, up 24, Brazil up 20. I put that down to kind of that materials, energy, real assets thing that we've been seeing. And then the one that I saw, on my screens, India down almost 1%. Is there any I've missed, Frank, or any themes you put behind that?
Yeah, probably the biggest theme I would take from the price action we're seeing most recently, and we sort of talked about this a little bit before the podcast, so I'm going to swing back to you on this one, Nigel, but it has been a real broadening of performance in markets. And if we think back to the themes we've talked about a lot over the last few years, it's been the very narrow performance of the share market, the Magnificent Seven, dominating returns, dominating earnings growth. What we're seeing now is quite different, that international markets have been beating the US. Emerging markets have been performing really strongly. Japan's had a really good run.
Yes.
Smaller companies have been beating larger companies. Companies from the kind of less loved sectors, materials, energy, been beating tech stocks. So quite a reversion to the mean going on within markets. And I think I'll bounce back to you for some rationale behind that. But once again, just another reminder to not over extrapolate the past, that things don't go in the straight line forever, that the unloved sectors today become tomorrow's loved sectors. And so I think, again, just a really important principle.
I heard a lot of commentary a while ago saying, so goes the Mag 7, so goes the market.
Yep.
Has that been proved wrong? As what I'm seeing is kind of the market's holding up, even if these Mag 7 companies tread water for a long time. So people are putting capital to work in just other things.
Yeah, now the maths of that does become tricky, just given the size,
law of large numbers,
scale, and index weight of those very large companies. So the smaller companies have to perform kind of consequently much greater, much better to make that maths work. But absolutely, and what's again, I hate coming back to these cliches, but they're cliches for a reason, that it's not a stock market, it's a market of stocks, and you can't just assume that every stock's going to be the same. So yeah, definitely.
I guess it's okay for some to take a breather. Just because something's not going up doesn't mean it has to not, or it doesn't have a place in a portfolio anymore. It can just tread water. It's still a great company. Let's talk. We've got a few other things we want to quickly get through. One of the key ones is election year. Obviously, we've talked with CTB and other guests around what's happening. Historically, it can mess with markets, maybe for better, for worse. Who knows? Do you pay attention as an investor to elections here or anywhere, or is it kind of like invest through?
In the past, I would have definitely said you could ignore elections, and
wherever they happen,
almost wherever they happen, and there'll be potentially some short-term noise from this policy announcement or that policy announcement, or this party being successful or that party being successful. But the slightly longer-term history of 12, 24-month performance post changes of government would indicate that, as much as our politicians would hate this being said, they don't really make a lot of difference, that the market tracks on. It's all about the dynamics of companies, earnings, and all those things that ultimately drive prices. I think sitting here for the last couple of years, that is a little different, in the sense that we do have this change to the wiring of the global economy, this move, as we've talked about, to a multipolar world. Those are politically driven decisions and dynamics that are going on, and there are real world consequences of that. We've talked about that in terms of commodities, re-onshoring of supply chains. All of those things are the consequences of political decisions and changes in political wiring. And if
you want the announcements, right? Even if it's rolled back.
Oh, look, absolutely. And I think if you want to listen to something really good on this, Mark Carney's speech at Davos this year.
Were you there?
At the World via the internet.
Okay, I thought you might have been skiing with.
Well, I was sitting in Canada, so I sort of felt like it was home. Felt like it was home court. Right. But Carney's speech is a tremendous discussion on the change to the world structure, the fact that as he puts it, the world structure has been ruptured, that there's a real multipolar dynamic that countries like Canada, Australia, New Zealand have to grapple with. And they are quite difficult, challenging situations for us politically to manage our way through. So I would say today politics is more relevant to how we manage money than it has been historically. But it's not the small announcements. The things I'm looking for are, hey, how does New Zealand navigate its position between China and the US, and how do we play those two big superpowers off?
Whether or not any political decisions or investment areas form or help support or form their own mega forces, maybe.
That's exactly right.
Yeah, as opposed to sort of the latest.
Yeah, the latest sort of micro announcements.
Noise. Yeah,
correct.
Two topics that refuse to die, for lack of a better term. Let's go to the first one, AI. and a bubble breakthrough, or just badly priced? I guess we've talked about this ad nauseum every week. Now, with your R&R and going through a Canadian winter, what's your current view on it? Has anything changed?
Yeah, I think it has changed, and so it's not so much necessarily my view has changed, but it's becoming a more pervasive conversation for every company. So this is not really about, is the Nvidia share price right, or is Google investing too much or too little in TPUs. It's now a conversation around, hey, how does JP Morgan utilize AI to drive profit growth within its business, to manage costs? How does every business in the world think about the dynamics of these changes? And I think one way I've heard it talked about is we've gone from an experimentation phase in that to an implementation phase in that. If you look at the frequency of AI mentions in corporate announcements,
I had that down in my notes.
Absolutely gone through the roof, right? So I think, of course we're interested in the Nvidia result. Of course we're interested in what's going on in those hyperscalers, but this is becoming, as is written on the tin. We do call this the AI plus digital disruption theme for a reason. The digital disruption part of this is becoming absolutely critical, and nowhere have we seen that more aptly demonstrated than in the SaaSmageddon, the big sell-off in software companies of recently. Yeah.
There is a research paper that's gone out, I think, from Sparkline Capital. Whether you've introduced, that one, isn't it? Yeah. I mean, you've introduced me to a lot since we've been working together, but to build on what you're saying, I think it's not just the AI term that's in earnings calls. They're mentioning things like AI's impact on earnings and then ROI, and they're saying it's inflected in the last few kind of quarters or so.
Yeah, these are real life examples of not just we're just fiddling with this, we are changing the operating frameworks of part of our business. So JP Morgan, for example, used to use, this is in the weeds of asset management, but for voting their securities, they used to use an external company to help them vote securities on behalf of their investors. They've now brought that in-house and have got an AI engine to help vote securities. That's taken cost out of their business, given them more control over that. These are real life applications for AI that are fundamentally changing the way business operate.
And the other one that keeps coming up, particularly at the moment, off the back of that kind of SaaSmageddon or software apocalypse, which we can cover maybe briefly soon, Bitcoin has really suffered to start the year, if not sort of towards the end of the last year. Do you have a view on it? Is it suffering from an identity crisis, or is it just basically, as we've seen, it's just treated as another kind of tech stock?
Will win you more friends or enemies than talking about Bitcoin, right? Depending on what camp somebody's sitting in. But again, I try to go back to the fundamentals of what was the promise of Bitcoin, what was written on the tin when we were all told it was going to be this epic thing that was going to go to the moon, and it was going to be a great hedge against geopolitical risk.
Yes.
It was going to be a store of value as
digital
fiat money was deflated away and debased. This was going to be the great store of value. It was going to be the new way that we transact between each other because it's more seamless, it's lower cost to transact. It's hard to argue that those arguments just don't seem to have held a whole lot of water when we look at the price of Bitcoin. And so rather than having a strong view on it, let's just think about why we might have thought about owning it and look at the facts. Do the facts support that argument? And I will say that the bull cases feel like they're being peeled away and peeled away and peeled away. It's just not behaved in the way that we might have thought it would behave, and that's a problem for the Bitcoin bulls. That they need to answer that. I'm not going to answer that one on their behalf, but they do need to answer that.
We'll let X, or formerly known as Twitter, I'm sure, the community. I guess I always look at it and go, when something's so sold off, you should start to ask what could go right.
Yes.
So that, again, I don't have an answer for that. But you sort of go, well, is it getting to that stage?
And look, the challenge for any kind of non-real asset, non-cash flow generating asset is, what is the right price for Bitcoin? There are definitely people who say the right price is $0.
$1 million.
And there are people who say the right price is $1 million. But there's no really good fundamental way to determine what that number is. Unlike, say, a company or a property investment or a fixed income investment where I can look at the future cash flows, discount them back to the present. We can debate what those cash flows are till the cows come home, but ultimately they do generate cash, and that underpins value. You just don't have that anchor with assets like Bitcoin, and that makes it intrinsically more speculative and more tricky to form solid views around.
It's not going. I think it's not going away. I think it's just, as Frank said, it's one of those things that's harder to get your hands around. Correct. I think I haven't looked at it for the last little while, but the New Zealand market seems to, in terms of New Zealand companies, New Zealand equity market, seems to have been pretty docile, fairly asleep for a while. Do you have a view on when is it going to wake up, or is there anything you think, because interest rates have come down, I would have thought it might have flowed through. Yeah. Is there anything that New Zealand's missing out on?
Yeah, so I'll make, again, a couple of observations about that. First, and this has been a bit of a theme of today's conversation, that you do need to look below the surface. So if we look at last year's performance, at a headline level, not particularly inspiring, but the performance of smaller companies and mid-sized companies actually had a really solid year, 18.5% return for the small and mid-cap part of the market in New Zealand over the last year. Those are companies that are much more geared to the New Zealand economy. And so the expectation that rates are falling, the Kiwi dollar is down, that should help stimulate economic activity in New Zealand. That does seem to have flowed through to the share prices of those smaller and mid-sized companies. At the headline level, you've got some really big cap companies in New Zealand, the Fisher & Paykel Healthcares, the Sparks, that have had their own issues in their own markets that have held back the aggregate performance of the New Zealand index.
Yep.
And again, it's really important to remember the New Zealand index and the New Zealand economy quite different things. So I think the New Zealand story is more positive than the headline would let you know, but it does need to follow through now. So analysts' expectations for earnings for this year are pretty aggressive, 20% earnings growth for the market for 26. We're about to launch into earnings season right now, so we'll be looking for proof points on that. And again, I think it will be the comments that companies make about the ongoing gentle uptick in the New Zealand economy that people will be looking for. So the average New Zealand company is not as bad a story as the headlines would suggest.
And final kind of question in this sort of section is, on a personal level, and this is not financial advice, but I wanted to add this in there because it gives a bit of colour in terms of what we're thinking about. So your own situation is your own, you should get advice, but we're just talking about what we're doing. Are you doing anything in your own portfolio because of January?
Yeah, look, I'm the world's most boring investor in many ways, Nigel. I don't respond a lot to market noise. I tend to have very much a set and forget long-term focus to my portfolio. So, for me, volatility is opportunities just to deploy more capital if prices get a bit silly. The movements in January, whilst they were really sort of aggressive from day to day, they don't represent big moves in the bigger scheme of things. That doesn't really change my views on that. So for me, I was focused on other things.
I've been I guess sort of sifting through some of the wreckage of the software apocalypse because I just got really obsessed by it, and I sort of thought, is everything being thrown out here with the bathwater? And I've added a few different bits and pieces. We won't mention specifics, but just ones where I thought that the prevailing first level narrative is it's software, it's going to be replaced, but it's not. So I've just tried to add a few different bits that I think will be beneficiaries of AI, but might have just, sort of been sold off a little bit. So I think that's a lesson for all investors, is to maybe just don't go with the prevailing narrative. Look under the hood, as you've been saying, and find there are pockets where you can look a little bit more detail. So
yeah, and I'll just quickly reflect on that one, just for those of you that don't follow markets quite as closely as Nigel. So it's a big part of our market that's software companies. It's like the Salesforce of this world that does ServiceNow, Workday, which does HR software, and the market narrative has gone from being quite positive on those companies to being they're all going to be destroyed by AI. Yes. Companies themselves will write their own software using
or you will
using Claude.
You'll write your own software.
We just won't need these businesses anymore. And look, the truth is always more complex than that. The challenge, I think, as an investor is really establishing a true picture of what the future looks like. And right now, that's pretty cloudy.
Yes.
Hence the big fall in share price.
Yeah, I think it's like sell first and then ask questions later. Yeah. To wrap up, I guess, what's a bit of advice that's stuck with you lately? Is there anything you've been reminding yourself? Whether that's on what you're hearing that you disagree with, or some of the old things, the same things, the best things don't change.
There was a really good podcast that almost as good as the ASB investment podcast, Nigel.
Good recovery there.
Sorry, it took me a second, but that I listened to, hosted by a guy called Mev Faber, who's a really good commentator on financial markets in the US, interviewing a really thoughtful long-term strategist called Russell Napier. He's a guy that I've followed for years and years. He's been talking about geopolitical fragmentation, the increasing debt levels in governments around the world, fiscal expansion, and the impacts that they will have on financial markets for a long time now. So well and truly forecast the sort of world that we're in. And he had an interview with me this month that I think is well worth listening to. We'll attach it to the show notes to the podcast, I think is the way you're supposed to say these things.
That sounded very legit.
Thank you. And like and subscribe and all that good stuff. He really talks about the importance of owning real assets old-fashioned assets in many ways in portfolios.
Not like coal mines. Or
Not like coal mines, but companies that actually make things and build things. And so real assets, so cautious about having too much cash because inflation is going to be problematic over time. So real assets tend to be better inflation hedges. Old-fashioned companies that can't be disintermediated by AI. And he also talks about some concerns about owning long-term government bonds. So those 30-year treasuries, maybe those 100-year bonds that Google's about to launch.
5 times oversubscribed, I saw.
Yeah. 100 years is a long time, huh? So and we've got that's the position we have in our portfolios. We're quite underweight those long-term interest rates. So these long-term drivers that I think are really important. What does that mean for us as investors? It means too much of your portfolio in cash is pretty risky in the sort of world that he sees being pervasive for the next 5-10 years. So I think that's really good long-term thinking that's worth pondering as we head into 26.
Okay, well, Frank, thanks for coming off the slopes to join us. It's great as always having you here in little old New Zealand. I'm sure keep the private jet warm at the airport. A final question that we always ask, and we're going to retain it for as long as until I get told to do something else. What's your recommendation for something you're reading, watching, or listening to this time that you can offer?
Well, I've talked about the Mid-Faber podcast. Yes. Definitely recommend listening to that. But on something very different, Matt Heath's book, A Life Less Punishing, sharing his life insights, thoughts around philosophy, learnings, introspection, and becoming a better human being. I was recommended it by, I'm lucky enough to serve on my local school board. We've got this phenomenal principal. Shout out to Rob Rush. Yeah. He recommended it to me. I literally bought it as I was having the conversation with him.
That sounds like you buying it.
Really enjoying it actually. And it's, it turns out, putting aside our investor hat, we want to be good human beings, but actually the more centered and balanced and thoughtful we are as people, that makes us better investors as well. So I think anything that helps us deal with the chaos of life a little better makes us a better person, but also makes us a better investor as well. So,
great. Yeah. I mean, I imagine that would have been a good one to read while you're nearly killing yourself going 70 Ks down slopes. My one, and it's not really a new thing, and it's not really one, it doesn't qualify for one of the categories neatly, but Frank for ages has been using kind of in the desk next to me, AI tools and stuff to research things and get quick answers. I hadn't really moved on it, but then over the break, I've started to really use it because I thought I need to know what these things are that I'm maybe investing with or against or disrupting things in the portfolio. And the example I was talking to Frank and the team about earlier was, help me plan a trip of 20 days to so-and-so countries for, you put in the details of your own family members and their age and stuff. And it literally comes back with a full itinerary. And the example was, would you like me to draft emails to all these hotels I found? And you kind of go, holy S word.
Yeah, it's a real thing, huh?
Yeah.
It's, some of the thoughtfulness and detail, if you get your prompt right, if you set the right context, it blows your mind.
And the takeaway from, and I guess to loop it back to the investment thematic, is it's hard to have a concrete opinion on what AI may or may not do if you're not aware of it. So you better start using it
100%
and know what you're dealing with. So thanks so much for joining us, Frank, and making it through the Queenstown fog this morning to get here. We were texting back and forth. I'm going to make it. I'm not going to make it. I'm going to make it. And we ended up making it. I hope you had a good time.
Always.
It's good to have you back this year, mate. And we hope you, on your headphones or wherever you're listening to this, we hope you enjoyed it. And more back and forth style episode, hopefully, rapidly getting through a lot of the topics that Frank and I have been monitoring across markets for the first 6 weeks of the year. So until next time, happy investing and bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.